In today's video, we are doing a deep dive into retail business accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Kumar Retail Mart operates within the retail industry, a sector valued at billions globally. Major players include companies like Walmart and Reliance Retail. Retailers buy products in bulk and sell at a markup. This industry's global context shows a trend towards e-commerce. Understanding these aspects helps in grasping Kumar Retail's position in the market and the scale of operations it handles. Kumar Retail Mart generates revenue primarily through product sales, both in-store and online. Additional income streams include service add-ons and membership fees. Major cost drivers include inventory purchases, logistics, and employee wages. Understanding these revenue and cost structures enables effective financial planning and highlights areas for potential cost optimization. For instance, negotiating better supplier terms can significantly impact profitability. In Kumar Retail Mart, several departments play crucial roles in accounting processes. Finance manages budgets and forecasts, operations oversees daily activities and cost controls, procurement ensures cost-effective supply chain management, and legal ensures compliance with regulations. Each department's contributions are vital for accurate financial reporting and strategic decision-making. For example, effective procurement strategies can lead to significant cost savings, impacting the financial outcomes positively. Understanding the workflow in Kumar Retail Mart helps streamline accounting processes. It begins with procurement, where goods are sourced. This is followed by inventory management, sales transactions, financial recording, and finally, reporting and analysis. Each step is crucial for maintaining financial accuracy and operational efficiency. For instance, precise inventory management prevents overstocking, reducing storage costs, and enhancing cash flow management. Kumar Retail Mart's stakeholders include customers, suppliers, government, and financial institutions. Customers drive revenue, while suppliers impact cost structures. Government regulations influence compliance costs and procedures. Banks and investors affect financing conditions and capital availability. Each stakeholder's interaction with the business holds accounting implications, such as managing credit terms with suppliers or ensuring tax compliance with government agencies. Understanding these relationships is crucial for effective financial management. Retail businesses like Kumar Retail Mart face unique challenges such as managing a fast-moving working capital cycle and navigating complex supplier contracts. Regulatory requirements for financial reporting and taxation add another layer of complexity. Addressing these challenges involves efficient inventory turnover and compliance with industry standards. For example, maintaining an optimal stock level reduces holding costs and ensures liquidity, which is vital in the competitive retail environment. Retail accounting at Kumar Retail Mart differs due to high transaction volumes and inventory management needs. Real-time sales data processing and inventory adjustments are critical. Unlike manufacturing, retail focuses more on sales patterns and consumer behavior to forecast revenues and expenses. This uniqueness requires robust accounting systems to handle data accurately. For instance, point-of-sale systems integrate with accounting software to ensure immediate financial recording and inventory updates. In Kumar Retail Mart, the finance team is primarily responsible for passing accounting entries. Triggered by sales transactions, inventory movements, or payment processing, these entries ensure accurate financial records. The team's expertise ensures compliance with accounting standards and timely financial reporting. For example, at the end of a sales day, entries are made to record revenue and adjust inventory levels, providing a real-time financial snapshot of the business. In this section, we will explore the comprehensive transaction lifecycle in a retail business context, using Kumar Retail Mart as our example. Understanding each step, from ordering inventory to final accounting entries, is crucial for maintaining accurate financial records. We'll discuss the necessary documents, involved departments, and potential challenges unique to retail. This knowledge ensures you are well prepared for both practical business operations and accounting interviews. The first step in retail accounting involves ordering inventory, which is typically handled by the purchasing department. They generate a purchase requisition using an inventory management system when stock levels fall below a set threshold. This process triggers accounting entries related to accounts payable. Errors can occur if the system data is outdated, leading to overstocking or stockouts, impacting cash flow and customer satisfaction. Once a purchase requisition is made, it must be approved by management to ensure budget compliance. This step involves cross-checking the supplier's price list and terms. The finance department may use a purchase order system to track approvals. An oversight here, like missing approvals, can lead to unauthorized spending and budget overages. Proper protocols ensure financial strategies align with operational needs. After approval, a purchase order (PO) is created and sent to the supplier. The PO acts as a binding contract, detailing quantities, prices, and delivery terms. The purchasing department handles this via procurement software. An error here, such as incorrect quantities, can disrupt supply chains and lead to financial discrepancies. Ensuring clarity and accuracy at this stage facilitates smooth transactions and accurate financial reporting. Upon receiving goods, the receiving department verifies the shipment against the purchase order. Any discrepancies are noted, and this information is fed into the inventory system. The receipt triggers an accounting entry for inventory and accounts payable. Mistakes, such as incorrect quantities or damaged goods, can affect inventory valuation and lead to financial misstatements. Accurate recording helps maintain inventory integrity and financial accuracy. After goods are received, the supplier sends an invoice, which the accounts payable department matches with the PO and goods receipt. This step ensures all documents align before payment. Invoice discrepancies can lead to payment delays or errors. A robust accounts payable process helps manage cash flow and maintain good supplier relationships, ensuring the company meets its financial obligations on time. Once the invoice is verified, the accounts payable department schedules the payment. This involves selecting the payment method, such as electronic funds transfer, and processing it through the financial system. Payment errors, like duplications or wrong amounts, can affect cash flow and vendor relations. Efficient payment processing ensures timely fulfillment of financial commitments, maintaining trust with suppliers and optimizing cash management. Reconciliation involves comparing the company's records with bank statements to ensure all transactions are accounted for. The finance team handles this by identifying discrepancies and errors. Mistakes in reconciliation can lead to inaccurate financial statements, affecting decision-making. Regular reconciliation processes help detect fraud, manage cash effectively, and ensure financial integrity, supporting accurate financial reporting and compliance with regulations. At the end of each accounting period, the finance team closes the books, ensuring all transactions are recorded and reports are generated. This includes adjusting entries for accrued items and reviewing all accounts. Errors during period close can lead to misstated financials and regulatory noncompliance. A thorough closing process supports transparent financial reporting, aiding strategic planning and satisfying stakeholders and regulatory standards. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition involves recording sales when goods are transferred to the customer. This is crucial in retail since sales volume is high, with numerous daily transactions impacting financial statements. Governed by standards like Indian Accounting Standard 115, International Financial Reporting Standards 15, and U.S. Generally Accepted Accounting Principles ASC 606, these frameworks require recognizing revenue when control passes to the buyer and performance obligations are met. In retail, an example is recording sales at the point-of-sale terminal. This differs from general accounting, where service-based industries may have longer revenue recognition cycles. Understanding this ensures retail businesses like Kumar Retail Mart accurately reflect their financial health. Inventory valuation is about determining the monetary value of unsold stock, impacting the cost of goods sold and profitability. In retail, where stock turnover is rapid, accurate valuation is vital for financial accuracy. Standards like Indian Accounting Standard 2, IAS 2, and U.S. Generally Accepted Accounting Principles, ASC 330, outline methods like FIFO, LIFO, and weighted average. For instance, Kumar Retail Mart may use FIFO to value groceries, ensuring older stock is accounted for first. This differs from industries like manufacturing, where inventory might be valued at different stages of production. Correct inventory valuation reflects true business performance. Lease accounting involves recording lease agreements, which is critical for retail businesses that often lease store premises. Governed by frameworks such as Indian Accounting Standard 116, International Financial Reporting Standards 16, and U.S. Generally Accepted Accounting Principles ASC 842. These standards require businesses to recognize both lease assets and liabilities on their balance sheets. For Kumar Retail Mart, this means recording the lease at its store locations as right-of-use assets, ensuring transparency in financial obligations. Unlike general accounting, where leases might be less frequent, retail heavily relies on leased properties, making this concept essential for operational clarity. Fixed assets and depreciation involve spreading the cost of tangible assets over their useful lives. In retail, assets like store fixtures and equipment are pivotal, and properly accounting for their depreciation affects financial statements. Standards like Indian Accounting Standard 16, IAS 16, and U.S. Generally Accepted Accounting Principles, ASC 360, guide this process. For example, Kumar Retail Mart depreciates its checkout counters over a set period, reflecting wear and tear. This differs from industries like IT, where assets like software may depreciate differently. Accurate depreciation in retail ensures correct asset valuation and expense matching. Deferred revenue arises when payment is received before goods or services are delivered, such as with gift cards or advance payments in retail. This concept ensures revenue is recognized only when earned, maintaining financial integrity. Governed by Indian Accounting Standard 115, International Financial Reporting Standards 15, and U.S. Generally Accepted Accounting Principles ASC 606, deferred revenue is recorded as a liability until fulfillment. For instance, Kumar Retail Mart records gift card sales as deferred revenue, recognizing it when redeemed. Unlike industries focused on long-term contracts, retail often sees quick turnover, emphasizing timely revenue recognition. Provisions and contingencies account for potential liabilities or uncertain obligations, like warranties or return policies, which are common in retail settings. Governed by Indian Accounting Standard 37, IAS 37, and U.S. Generally Accepted Accounting Principles ASC 450, these standards require businesses to estimate and record such liabilities if probable. For Kumar Retail Mart, having a return policy necessitates estimating potential returns, which impacts financial statements. Unlike industries with fixed liabilities, retail's customer-centric approach demands flexible accounting for potential contingencies, ensuring accurate reflection of financial risks and obligations. Cost allocation involves distributing indirect costs like marketing or rent across products, which is vital for analyzing profitability and determining pricing strategies in retail. While not governed by specific accounting standards, general costing principles guide this process. For Kumar Retail Mart, allocating shared store expenses across product categories helps in setting competitive prices and understanding margins. Unlike industries with direct cost associations, retail's diverse product lines require thoughtful allocation to ensure accurate financial insights and operational strategies. Segment reporting involves breaking down financial information for different business segments, crucial for retail chains with multiple locations. Governed by Indian Accounting Standard 108, International Financial Reporting Standards 8, and U.S. Generally Accepted Accounting Principles ASC 280. These standards enhance transparency by revealing segment-specific performance. For Kumar Retail Mart, disclosing financials for each store location aids in understanding profitability and guiding strategic decisions. Unlike industries with homogeneous operations, retail benefits from segment reporting to identify strengths and opportunities across diverse geographic and product segments. Financial instruments in retail encompass cash, receivables, and payables, crucial for managing liquidity and operational cash flow. Governed by standards like Indian Accounting Standard 32, International Financial Reporting Standards 9, and U.S. Generally Accepted Accounting Principles ASC 320, these instruments require careful management to mitigate financial risk. Kumar Retail Mart, for instance, deals extensively in short-term receivables from credit card sales, impacting liquidity. Unlike industries with long-term financial assets, retail's focus on short-term instruments necessitates agile financial management to sustain business operations and growth. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. This entry marks the start of Kumar Retail Mart, where the owner injects capital, creating a financial foundation. The cash account increases, reflecting the business's liquidity, while equity share capital rises, signifying ownership interest. This step is crucial for funding initial operations, covering expenses, and building inventory. Injected capital is essential for establishing a business's operational groundwork. By purchasing inventory on credit, Kumar Retail Mart increases its stock without immediate cash outflow, enabling future sales. This entry reflects an obligation to pay suppliers, introducing accounts payable. Inventory is a current asset, critical for revenue generation. Managing credit terms strategically helps maintain cash flow, while ensuring the company has sufficient products to meet customer demands. Selling inventory for cash increases liquidity and generates revenue, crucial for business sustainability. Recording the cost of goods sold, COGS, reflects the expense associated with inventory, impacting profitability. This transaction demonstrates the business cycle: acquiring goods, generating sales, and recognizing costs. Revenue and COGS entries are vital for understanding gross profit margins, a key profitability indicator. Paying suppliers fulfills credit obligations, maintaining good supplier relationships. This action decreases accounts payable and reduces cash, reflecting outflow. Timely payments ensure favorable credit terms and supplier trust, which can lead to better future purchasing conditions. Managing payables is part of effective cash flow management, crucial for maintaining operational liquidity and financial stability. Utilities expenses are essential costs for running a retail business, covering electricity, water, and other basic needs. Paying these expenses is crucial for uninterrupted operations and customer satisfaction. This entry records a decrease in cash and recognizes an expense, affecting the income statement. Efficiently managing such operational costs is key to maintaining profitability and sustaining daily business activities. Paying salaries is fundamental for maintaining a motivated workforce, ensuring smooth retail operations. This expense reduces cash and impacts the income statement, necessary for calculating net income. Salaries are a significant part of operating expenses, and managing them efficiently is vital for controlling costs. A well-compensated team contributes to better customer service and overall business success. Interest payments on loans reflect the cost of borrowing, impacting the financial health of Kumar Retail Mart. This expense reduces cash and appears on the income statement, influencing net profit. Managing interest expenses is crucial to avoid financial strain and ensure resources are available for growth. A strategic approach to debt can support expansion while maintaining financial stability. Depreciation reflects the gradual reduction in value of fixed assets like equipment. This non-cash expense spreads the cost of assets over their useful life, affecting profitability. Recording depreciation impacts the balance sheet and income statement, aiding in accurate financial reporting. Understanding asset depreciation is vital for planning replacements and managing long-term investment strategies, ensuring sustainable business operations. Year-end adjustments close temporary accounts, resetting them for a new fiscal year. Closing revenue and expenses into income summary calculates net income, which then transfers to retained earnings. This process ensures accurate financial reporting, reflecting the company's profitability and retained wealth for future use. Proper accounting closures support financial clarity, aiding in strategic planning and stakeholder confidence. In this section, we'll explore how various accounting transactions impact the financial statements of Kumar Retail Mart. Understanding these impacts is crucial for making informed business decisions. We'll start by examining the balance sheet, then move to the profit and loss statement, and finally the cash flow statement, Each transaction tells a story about the health and direction of the business, guiding strategic planning and investor relations. For Kumar Retail Mart, current assets like inventory and accounts receivable increase with debits, indicating purchases or credit sales. Cash decreases when used for payments, seen as a credit. Prepaid expenses, when paid, also increase assets. These movements reflect how Kumar Mart manages operational liquidity and customer credit, crucial for a retail business where inventory turnover and cash flow are significant concerns for sustaining day-to-day operations. Non-current assets like property and equipment increase with debits, reflecting long-term investments. Long-term debt as a credit increases liabilities, signifying borrowed funds for asset acquisitions. Accumulated depreciation credits indicate asset value reduction over time. Retained earnings grow through credits, symbolizing reinvested profits. These elements illustrate Kumar Mart's strategic investment choices and debt management, essential for long-term growth and stability in the competitive retail sector. In Kumar Retail Mart's profit and loss, sales revenue is credited, enhancing overall revenue. Cost of goods sold incurs a debit, raising expenses directly tied to sales. Gross profit, the net of sales and direct costs, reflects operational efficiency. By analyzing these, Kumar Mart can pinpoint profitable items, optimize pricing, and manage supply chain costs, which are critical for maintaining competitive pricing strategies and maximizing margins in retail. Operating expenses, debited, represent indirect costs like rent and utilities. EBITDA, calculated before interest, taxes, depreciation, and amortization, shows operational profitability. Profit before tax further refines earnings, highlighting pre-tax efficiency. For Kumar Retail Mart, monitoring these metrics is vital for budgeting, cutting unnecessary costs, and planning tax strategies, ultimately supporting sustainable growth and shareholder value in an environment where cost control is as crucial as revenue growth. Operating activities indicate cash generated or used by Kumar Mart's core business operations. Investing activities reflect cash used for acquiring or selling long-term assets, affecting future growth. Financing activities show cash flow from borrowing or repaying debts, impacting capital structure. Understanding these sections helps Kumar Mart manage liquidity, plan investments, and ensure sufficient cash for operations, which is vital in the retail industry, where cash flow timing can significantly impact operational decisions. Key ratios like the current ratio gauge Kumar Mart's ability to meet short-term liabilities with existing assets. Inventory turnover assesses stock efficiency, crucial for retail, where quick turnover is key. Gross margin ratio evaluates profitability per dollar of sales, guiding pricing strategies. The debt-to-equity ratio indicates financial leverage, balancing growth with risk. These ratios provide a comprehensive view of Kumar Mart's financial health, aiding strategic decisions in a competitive market. In this section, we will go through all the key concepts of common errors in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Inaccurate audit findings in retail, like at Kumar Retail Mart, stem from errors in recording sales or inventory. These inaccuracies can mislead stakeholders about the company's performance. They often occur due to rushed data entry or system errors. Auditors detect these by comparing internal records with external confirmations, such as bank statements or supplier invoices. Correcting these errors involves ensuring all entries are accurate and regularly reviewing transactions for consistency and reliability. Interview traps often catch candidates off guard when they're not familiar with specific retail accounting scenarios, such as handling inventory shrinkage or seasonal sales fluctuations. At Kumar Retail Mart, candidates might face questions on managing cash flow discrepancies or implementing effective internal controls. These traps are common because they test practical knowledge, not just theoretical understanding. Preparing by reviewing real-world case studies and practicing scenario-based questions can help candidates confidently navigate these challenges. ERP system mistakes at Kumar Retail Mart often happen when employees incorrectly input data or fail to update system changes promptly. These errors can cause discrepancies in inventory management or sales recording, leading to inaccurate financial statements. Such mistakes usually occur due to a lack of training or system updates. Correcting these involves conducting regular system audits and providing comprehensive training to users. Auditors typically identify these errors by tracing data flow, and checking for inconsistencies across the system. In retail, cutoff errors and revenue recognition at Kumar Retail Mart can distort financial outcomes when sales are recorded in the wrong period. This typically happens when transactions are rushed near period end, leading to revenue being recognized either too early or too late. These errors affect income statements and can mislead stakeholders about the company's performance. Auditors detect these by ensuring sales transactions align with actual delivery times. Correcting involves strict adherence to revenue recognition principles and accurate period-end procedures. Standard switching errors at Kumar Retail Mart occur when the company fails to consistently apply accounting methods, such as switching between LIFO and FIFO inventory valuation without proper documentation. These errors often result from inadequate training or misunderstanding of accounting standards. They can significantly affect financial statements by altering reported profits and tax liabilities. Auditors identify these inconsistencies by reviewing accounting policies and comparing them with industry standard practices. Correcting these errors requires consistent application and thorough understanding of the relevant accounting standards. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Accurate inventory valuation is essential because it directly affects the cost of goods sold and net income. For Kumar Retail Mart, using methods like FIFO, LIFO, or weighted average impacts financial statements and tax liabilities. An incorrect valuation can mislead stakeholders about the company's profitability and financial health, potentially leading to poor decisions. Understanding this helps ensure transparency and compliance with accounting standards. The cash flow statement is crucial as it highlights the liquidity and cash position of Kumar Retail Mart. It shows cash inflows and outflows from operations, investing, and financing activities, helping managers assess the company's ability to generate cash. This information allows the Mart to plan future cash needs, ensuring they can meet obligations and invest in opportunities. It bridges the gap between income statement and balance sheet, providing a clearer financial picture. Discounts offered to customers should be recorded as a reduction in revenue at Kumar Retail Mart. For instance, if a product is sold for $100 with a 10% discount, the revenue recognized should be $90. This reflects the true earnings from sales and maintains accurate financial reporting. Recording discounts separately helps in analyzing their impact on sales volume and profitability, enabling better strategic decisions about pricing and marketing. Under International Financial Reporting Standard 16, Kumar Retail Mart must recognize leases as a right-of-use asset and a lease liability on the balance sheet. Initial measurement involves calculating the present value of lease payments. Lease payments then reduce the liability, while depreciation and interest are recorded in the income statement. This approach reflects the financial obligations accurately, providing a more realistic view of the company's commitments and assets. When inventory is damaged, Kumar Retail Mart should debit a loss account and credit inventory. For example, if $500 worth of goods are damaged, debit loss on inventory write-down and credit inventory for the same amount. This reflects the reduction in asset value and acknowledges the financial loss. Regular assessment and recording ensure accurate inventory valuation, essential for financial reporting and decision-making. Indian Accounting Standard 115 requires Kumar Retail Mart to recognize revenue when control of goods transfers to the customer. This typically occurs when goods are delivered and the customer assumes ownership risks. The amount recognized should reflect consideration expected to be received, considering discounts and returns. This principle ensures revenue is matched with the period in which the performance obligation is fulfilled, providing a clearer picture of operational success. Kumar Retail Mart must record foreign transactions at the exchange rate on the transaction date, converting amounts to local currency. At period end, revaluations are necessary, with gains or losses recognized in profit or loss, unless hedge accounting is applied. For example, if goods are purchased at $100 and the exchange rate changes, adjustments ensure financial statements accurately reflect current values, impacting reported profitability and financial stability. Implementing an ERP system streamlines Kumar Retail Mart's accounting by integrating financial data across departments, enhancing accuracy and reducing redundancies. It automates tasks such as invoicing and reporting, saving time and minimizing errors. Real-time data access aids in strategic decision-making, improving inventory management and customer service. Additionally, ERP systems ensure compliance with accounting standards by maintaining consistent and up-to-date records. In consignment sales, Kumar Retail Mart acts as an agent, not recognizing revenue until goods are sold to third parties. The inventory remains on the consignor's books. When sold, Kumar Retail Mart records commission income, debiting cash, and crediting sales and the consignor's payable account. This method ensures accurate representation of revenue, reflecting the mart's true earnings from facilitating sales rather than outright ownership. Deferred tax liabilities occur when there's a difference between taxable income and accounting income, typically due to temporary differences like depreciation. For Kumar Retail Mart, recognizing these liabilities is crucial as they represent future tax obligations. Proper accounting ensures compliance and accurate financial forecasting. Understanding deferred taxes helps in planning cash flows and maintaining financial stability, as they impact the timing of tax payments. In running a retail business like Kumar Retail Mart, understanding the business model is key. They focus on purchasing and selling goods while managing inventory effectively to avoid overstock or shortages. Building strong supplier relationships can lead to better payment terms, and utilizing multiple sales channels expands their market reach. Customer service plays a pivotal role in loyalty, while regular market analysis aids in adapting to consumer trends. A competitive pricing strategy helps maintain a consistent customer base. Accounting in retail involves recognizing revenue upon transfer of goods, not just when cash is received. Inventory valuation methods like FIFO or LIFO impact financial outcomes. Expenses should align with the revenue period under the matching principle. Journal entries maintain the double entry system's integrity, affecting 2 accounts per transaction. Accounts receivable tracks customer debts, vital for cash flow. Depreciation spreads asset costs over time, and financial statements guide financial health assessments. For interviews in retail accounting, it's vital to grasp retail operations from purchasing to sales and customer service. Familiarity with generally accepted accounting principles relevant to retail, and proficiency with accounting software like QuickBooks is often required. Analytical skills help interpret financial statements for strategic decisions. Problem solving demonstrates your ability to address financial issues, while strong communication is key for conveying insights to non-financial stakeholders. Awareness of current industry trends shows your knowledge and adaptability. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to CandiMentor for more finance and accounting videos.